Okay, the third and final company that I want to talk a little bit more about was Markel. Again, this is our largest holding. Became our largest holding right before Christmas holiday season last year. Um, I think it's sort of curious that the blueprint that is Berkshire Hathaway, Warren Buffett's company, that blueprint for how to grow your own wealth so dramatically over time, it's been out there for so long, but nobody has really mirrored it. Um, Buffett really built what I don't think it's hyperbole to say was really a compounding machine, and he did it in a very deliberate, very intelligent way. And you would just think, all right, well, there's lots of people who would like to be worth $50 billion, and why haven't more of them just basically copied what Buffett did? There's nothing proprietary about it. It's fairly straightforward. It's very transparent. Well, why is it that nobody's really mirrored that lesson? And that's, I guess, kind of where Markel comes in. First off, just sort of his background, Markel is a very well-run specialty insurance company. It's been compounding, book value, shareholder equity consistently at about, call it 16% a year over the past 20 years. Markel operates with a similar business model to that of Warren Buffett's Berkshire Hathaway. Specifically, it writes insurance policies to collect premiums, and then it invests the float. And to be clear, Berkshire does a lot more these days. But in terms of the sort of the earnings power of both companies, that's really where it comes from. Insurance companies make money in those two main categories, really. Underwriting profits and then investment profits. Many insurance companies actually lose money writing the insurance part, but still, eke out some positive returns on the investment side. Unless, if you're in Monroe County, unless you're familiar with Citizens who, seem to screw up both sides, but, that's a whole other story. The point is it's very difficult for insurance companies to produce consistent underwriting profits. That's for a couple reasons. Number one is really related to competition. It is, at this point, a fairly competitive business. The other reason it's hard to do is because what could probably just really sort of be described as greed at some level. The temptation to sell those policies, even when it might not be the best policy from the underwriter's perspective, it can be overwhelming, or at least a little bit too desirable for both agents, I'm talking, and the folks in HQ of these companies. The best insurance companies are profitable over time, though, in both their underwriting and their investment groups. And that's, again, greatly simplified, but it also kind of neatly summarizes the success that Berkshire has had over the years, as well as Markel. Now, the beautiful thing about running a profitable insurance business is that the float is free and permanent, really. And float is an insurance term which very generally means the temporary funds that the company controls after accepting premium payments but before paying out claims. As long as the underwriting in that company is profitable, that float is essentially an interest-free loan that never has to be paid back. And if that's the case, then, well, you can invest that in long-term securities, such as stocks and bonds, and you can really compound that value when you've got a great value investor at the helm. In in Berkshire Hathaway's case, that's Warren Buffett. In Markel's case, it's a gentleman named Tom Gaynor. Could talk a lot about Tom, but the point is he's significantly younger than Buffett, and while I don't think anybody is going to have quite the investing track record that Buffett did, Tom Gaynor is a very skilled, very sharp value investor. Yeah, exciting to be able to sort of partner up with him in owning Markel in that sense. So fast forward, Markel acquired a really well-run reinsurance company at the end of last year. It's called Altera. Reinsurance companies are the ones who basically sort of underwrite the risk that other insurance companies put out there. And again, was sort of key to Buffett growing Berkshire Hathaway. And my theory is it's going to absolutely be key to Markel's sort of second stage or this transformative stage of growth that I expect to see in Markel. Those reinsurance companies throw off a ton of cash, to greatly simplify. And if your insurance operations are profitable on the underwriting side, then again, all that cash that's being thrown off, it essentially becomes float that you will have forever and can invest long term and really further compound the value in your company. So again, this was another opportunity. It was good to sort of be right place, right time. Excuse me. And if you were wondering why we sold some Clearwire shares and MacBrand shares before the deal was actually consummated in terms of both those acquisitions, well, this little drop in the stock price chart last December really speaks to that. The shares of Markel dropped really off a cliff once they announced that they were acquiring Altera. This was, again, right before the holidays. Now, there's technical reasons why the price did what it did. I think the most obvious explanation is that when companies announce they're acquiring other companies, there are arbitrageurs who simply will short the company that's doing the acquiring and go long the company that's being acquired to try to eke out some very small profits when the deal actually happens. So kind of vacuuming up pennies before, making very small profit on what should be a certain trade. You can tell Markel fell down to $4.34 per share, and it just seemed one of those too good to be true opportunities. And again, another example of where we bought our shares really right where that purple arrow is. I would not have expected that shares would bounce back as quickly as they did, but clearly there's other folks out there who's seeing the same sort of value in Markel. It's kind of the trifecta of potential, I think, when it comes to Markel. Number one, the insurance markets in general that they operate in are sort of hardening, which means better pricing for them. They've got this great sort of free cash flow generating engine now in Altera, the reinsurance company that they acquired, and interest rates are going to start to rise. So to the extent that insurance companies carry a lot of fixed income instruments on their books, because they need it to be safe and dependable and to have some money there to pay out principals. To pay out premiums. To pay out claims that come in. A little too much Cuban coffee. Sorry. They're sometimes required by the regulators to maintain a certain percentage of their portfolio in fixed income. So interest rates are on the rise. That's going to do good things for Markel's investment portfolio. That's just been the fixed income portion that's been earning nothing. You've got the insurance market hardening, and now you've got Altera bundled in there. So it's just seemed like the great opportunity, and it is still our largest position, and I suspect will be for some time. I feel like that acquisition and just kind of paying attention and being able to create some cash fairly quickly, it really kind of gave us what I think is going to prove to be an amazing gift in the coming years in terms of owning Markel. All right, now's the portion of the annual meeting where I do a very superficial job of sort of macro-related concerns. Call it the outlook section of this thing, but again, I don't spend a lot of time trying to guesstimate what GDP growth is going to be like in the next quarter. It's almost impossible to completely tune out things that are going on these days, whether it's in Japan or Europe, and I don't know that you want to, but the point is, we invest from a bottoms-up perspective. We're looking at companies based on the cash flows and not trying to, predict what's going to happen in other more macroeconomic areas around the world. One of my favorite quotes from Peter Lynch. So, consider this the 10 minutes you're going to waste. A couple things that I think are really sort of underappreciated in terms of economic developments, I would guess, the next few years. And really it all comes down to housing. We are, I think, through the bottom, to greatly simplify, of the housing debacle. We're coming off the bottom. I think anybody local understands that it's picking up a little bit here in the Keys. It seems to be picking up really a lot of other places, and this is just a good indicator showing that inventory, all those homes that have just sort of been sitting, metaphorically on the shelf or in the warehouse, that supply is starting to come down. And to greatly simplify, this is a good thing. I think for obvious reasons, but it's not just the economic sense. I think psychologically, you'll sometimes hear economists talking about the wealth effect and how specifically when people feel like their homes are increasing in value, they feel more wealthy, and then they, in fact, do go out and buy more things because of that. Now, too much of that, you could argue, got us into the mess to begin with, or helped get us in there. But the point is, it's all very positive, and this housing recovery, although it's going to continue to probably be a little bit sporadic in terms of the rate of increase, it's clearly through the bottom and going back up. This is good. And here's sort of how economists kind of define the wealth effect, but it is what it is. In the short term, this is kind of a snapshot of, call it the market fair value. The point being that right now, at least on the 17th of May, you could argue that the market as a whole was probably a little bit overvalued. I'm not, again, I don't spend too much time worrying about the market as a whole. I'm very focused on specific companies. I will tell you, though, that when the market kind of swings as much as it has over the last year, being probably significantly undervalued to a little bit overvalued, it does become a lot harder to find really good companies for us to invest in. I feel like my challenge is to kind of keep from sort of sliding down the quality scale. I mean, you can always find cheap companies out there, but are they both cheap and good? Well, sometimes that gets debatable. So try not to compromise on the quality of companies we invest in which case it kind of has meant for the last 3-4 months just kind of sitting on my hands and essentially waiting. Still doing a lot of reading, kind of keeping the watch list that much more up to speed and updated. But things are not quite as cheap. Even the new companies that were most attractive to me on that watch list, hoping to get them cheaper. And, to kind of take off the annual meeting hat, was able to do that at the end of June, early July, after some volatility and the Fed Open Market Committee meeting notes and all that. Yeah, the market as a whole is probably close to fairly valued even now, which the bottom line is I don't expect we're going to see huge swings up or down in the market based just on fundamental valuation methods, and that is distinct probably from the last 4 or 5 years where we have had the market as a whole has been at various times very undervalued, and just being in the market has certainly been a tailwind for us. My hunch is, though, that the actual stock selection, and this sounds a little bit cliched, but I do think it's true, actual stock selection is going to make that much more difference for you as an investor in periods where the market is, not at an extreme, either over or undervalued. This just sort of gives a highlight. Yeah, it's kind of put things in perspective to back up a little bit. On the circle on the far right is kind of where we are right now, if you presume that things are a little bit overvalued. But even the last 10 years, things have been a lot more overvalued than they are right now. You can see back in late 08, 09, things got crazy undervalued. So just a little bit more perspective for all that. It doesn't influence, what I'm doing on a daily basis, but it does help explain why, it's a little bit harder to find companies to invest in as the market keeps going up. More relevant is, again, what I sort of feel the price to fair value is of Tarpon specifically. And that really, it's an interesting time in Tarpon. I feel like the companies that we own still have considerable room to run, if you will. They're still dramatically undervalued. And this little snapshot here is exclusive of the cash that's in the portfolio. So it's not entirely accurate. The price to fair value is not 0.5. It's not on sale by half if you include the cash that's in there. But the point is, I feel like we've still got some real value in there, but not trying to time the market so much as be very specific about the price that we pay for new companies. So I think this is exactly where we want to be in terms of, whether it's new investor money coming in. I've had a lot of new investors and/or some of you long-term investors who've been sending money into your accounts the last 4 or 5 months, and it's really just been sitting. Should we see a blip in the market, and we did see one of these, in early June, can start putting more of that money to work. To summarize, I would say I still feel very good about Tarpon's long-term prospects. It is significantly undervalued, at least the way I track these sorts of things. And I think that in the past, that speaks to all things being equal, good opportunities and ostensibly good results over the long term because of that. There's always, of course, a gazillion things to be scared about when it comes to the markets. There are certainly some things out there that I am more concerned about than others. I guess I would say in general, the kind of meme in the media about the Fed being dangerously aggressive the past few years. I'm not, I understand intellectually and maybe politically where that comes from, but I'm just frankly not seeing it. We have had 4.5 years of really an overnight rate near zero, and we've had obviously very aggressive securities purchases by the Fed. That has succeeded in raising asset prices. I don't think there's much question about that. And whether you look at the stock market or more near-term housing market, the question is really whether those higher asset prices will deliver the jobs and economic growth the Fed wants before they become destabilizing, I guess. And right now, it's just too early to be concerned about potential destabilization. Is it something that's in the back of my head? Yeah, absolutely. But right now, the data is simply not there. Now to be clear, high government debt and lots of promises in general, is sometimes worth worrying about. And right now, that absolutely makes the list. But to be candid, I tend to worry more about things like those idiot bombers in Boston more than the Fed itself right now. So just kind of I tried to not take a macro approach to this and focused exclusive of Europe, which is still working through some things, exclusive of Japan, which has its own headwinds here. Here are the things that kind of concern me at kind of a high level when it comes to I guess the markets and by extension Tarpon in general. HFT is high frequency trading. This is just kind of a snapshot of what is probably unintelligible, but it really is what's called quote stuffing. It's high frequency traders, computers, algorithms, in other words, essentially spamming the quotes provided by exchanges regarding specific tickers. So this could, and I forget which one this is, but it is a slew of very deep liquid blue chip companies, IBMs, those sorts of companies of the world. This is just noise that's in the system. The thing that sort of torques me about high frequency trading, number one, it's kind of legalized front running. It's a way for basically hackers to sort of game the system and figure out which big institutional funds are either buying or selling a particular security, and by kind of picking up those pennies in front of the steamroller, high frequency traders can make a ton of money. The problem is what that is considered is called front running, and front running is illegal, which in and of itself is probably worthy of a discussion. But more to the point, the problem that I have with HFT is that it's essentially a tax. It's just a tax on all of us. All these little fractions of a pennies that these algorithms move around for us. It's a tax that we as investors pay. It doesn't go to the government. It goes to these private companies. And if nothing else, that is frankly pretty annoying. To be clear, I'm not. I think these high frequency traders, they're sort of sowing the seeds of their own destruction. If it doesn't come from the regulatory arm of the government, then it's simply just going to be because this is a business that there are no moats. These high frequency traders, there's nothing to prevent, other than some capital and some servers, nothing to prevent anybody from becoming a high frequency trader. That's greatly simplified, but the point being that these guys are, and even now, in the process of competing their own profits away. Let's hope that in 5-6 years, it's no longer as big a deal, whether it's because they're fundamentally, not long-term sustainable businesses or regulations. But it is something that concerns me. For instance, the flash crash back in May of 2010. We're not trying to trade on a daily basis, but the reality is those sorts of things caused by high-frequency trading, they do sort of undermine people's confidence in the markets in general, and that's just not healthy for any of us. So it's on the list of concerns for sure. Bonds are the other, I think, big thing to be concerned about in general. This is, again, a little bit hyperbolic, but the quotes are from, the man himself. A couple different annual letters he's put out. Not a lot of people, I think, understand how sensitive that bonds can be to changes in interest rates. This was, just stole it right from the Wall Street Journal, so all credit there. A fairly simple but still good attempted explanation of why exactly bonds, as Buffett is cited, could be a source of real problems for bondholders in the market. And you can kind of walk through the text yourself, but the point is, even a small change in interest rates can have an outsized impact on the principal value of a bond, if you will. And if you presume that interest rates have for a while now been at an all-time low, interest rates are eventually going to go up, and that really is going to, I think, could cause some havoc in the bond market in general. That sensitivity, it's something that is probably not fully appreciated by a lot of investors, and it's absolutely worth thinking through this. I mean, your assets that are held outside of IIM, you need to be thinking about bonds in particular the coming years, really. Again, just more proof. All right, we're over in the lower right-hand corner. Clearly, interest rates have nowhere to go but up, and because the relationship between interest rates and bond prices is inverse, as interest rates go up, bonds go down in price, then that's going to hopefully not cause too much havoc to people who are paying attention. But it's something that's in the back of my head for sure. Unemployment is also makes my list of concerns. Again, the sort of the moral aspect of it, of having so much of friends and or family that have just been out of the workforce for an extended period of time. But it's also, in the economic sense, it becomes that much harder to sort of get escape velocity in this economy if such a high percentage of people simply aren't working. It's just it's simply math in that sense. Again, many different kinds of charts you can have to underscore the problems of unemployment, but I thought this was a good one in terms of really highlighting how persistent the unemployment problem has been as a result of the Great Recession compared to other ones in the past. So it is a big issue, and whole other discussion about the Fed and trying to focus on that. And I'll just summarize and say that is of concern to me. The last thing is really sort of more political based. If there's a lesson of the last few years, it's that the political risk, particularly in Europe, has been so hard to quantify and predict that it has made for some very volatile stretches. When it comes to the U.S., though, the biggest political issue I think right now is sort of about the political economy and demographics, specifically unsustainable promises made to retirees for health benefits. It isn't new. It isn't about the Fed, nor even about the extra debt we lopped on during the recession. It could certainly cause things to kind of spaz out at some point near or far, or maybe it won't. We're in uncharted territory when it comes to some of the fiscal and monetary policies we're looking at, and we just have to, or at least I have to, closely watch and see what happens. So that kind of brings to the forefront, all right, well, what exactly is going on in D.C.? And we think intrinsically, I think everybody realizes it's a very polarizing time in D.C. It's a bad time to have a polarized D.C. because we have serious problems we're still working through. So I think a very valid question is, all right, well, how much do we need to worry about, our esteemed representatives in D.C.? And as it turns out, well, there's people who try to quantify that. You see on the left, the House of Representatives, even 20 years ago, was polarized, but there was still some ideological overlap. Right now, there is no overlap. So the polarization, at least as measured by people who track these sorts of things, is at a record high, as you can even see here. And these these charts go back to really, sort of right after the Civil War, right? I mean, on the left-hand axis there, all the way to the left. This sort of thing, at least the data is there, good, bad, or indifferent, for a long time. And the fact that polarization is higher now than it really has been in that amount of time in both the House and the Senate, neither one's immune. That's in general just not a good place to be when we have problems that we need to work through, and our leaders can't even really get along. Just more data here. The number of moderates in each party is also at record lows. Again, probably a whole another sidebar discussion that I don't intend to get into with politics and or things going on out there, but it is certainly a headwind, or has the potential to be a self-inflicted problem if we're not careful about it. And then to summarize all those previous three slides about politics in general, Congress has really been sort of MIA for some time now with regards to sincerely attempting to address some of the bigger economic issues we face. I don't want to be alarmist about this. It may very well be that the increase in receipts that the government's getting as the economy improves means the debt ceiling issue is not going to again be an issue, at least to the extent it was before. But it's also fairly easy to make the case, based on how much partisanship there is, based on the simple math of when we are going to be approaching the debt ceiling. You could presume that gridlock and brinkmanship in D.C. It's been really sort of on a holiday for a while now, but it could very well be back before Labor Day, around that time. And the Labor Day, that's sort of a floating goalpost, if you will, in terms of that's when folks believe we're going to be forced to do something about the debt ceiling, i.e. raise it again, and we all sort of know how that went a few years ago. So one more reason to, I think, not get carried away in terms of the market in general. Still looking for opportunities. This in and of itself isn't influencing on any meaningful level what I'm doing on a daily basis, but it may be best to stand by for some increased volatility later in the summer, thanks to our folks in DC. Hope not, but it's a possibility. That said, I am not overly concerned with any of these things. I feel like if you look at the last 100 years of times to be an investor in this country, right now, it doesn't even make my list of top 20 times to be worried about being an investor. It's always difficult to invest for various reasons. It's always a challenging time, it seems, to rely on any sort of political leadership to get anything done. But I put this slide up there. Let's keep in mind the long view. As value investors, we are fortunate in that we can keep in mind that long view, and more to the point, let's just keep things in perspective. So keeping that long term in mind as an investor is absolutely essential. This is sort of a graphical version of some of Buffett's own thoughts he put out. I think it was a letter near the trough of the credit crisis a few years back, and the point I think was very valid. If you just look at the last 100 years in terms of the stock market and what investors went through over those 100 years, it just really encapsulates the value of being long-term in thinking, and also, how well this country can work in many ways. Over the last 100 years, gone through a Great Depression, 2 great wars, one of which, we thought we were going to lose initially. There's been a dozen panics and recessions. We've had really, truly rampant inflation. Not the fear of inflation, but truly rampant inflation. Prime went to 21.5% in 1980. But in spite of all those headwinds, standard of living for Americans went up 7x, and the Dow went from literally 66 points in the Dow to 11,500. So all is not lost. Even if things get a little heated around this debt ceiling debacle, the end of the summer, I'm not concerned. It's not going to change what I do in any way, shape, or form. In a sort of perverse sense, I guess, I look forward to seeing some more volatility and putting a little bit more money to work. But the reality is, there's always things to be concerned about as an investor. In the grand scheme of things, I am not too concerned about whatever may come the next few months. So that's really it as far as the annual meeting went. I had some in the actual annual meeting. At this point, had a few questions from the audience. At this point, if you've seen this and you have questions you'd like to bounce off me, I'd ask you please send me an email. Everybody's got my email, csmith@ilinvest.com, and happy to take a look at it then. Hope it was all useful for you. Apologize if it were rushed and or a little bit unpolished, but that's just how it is, I guess, on some of these things. Look forward to continuing to work with everybody. You'll hear more about Loretta and her new spoke funds in the not too distant future. And thanks for listening.